Zero.
Good morning and welcome. Thank you all for joining us today. My name is Samantha, and I'm the Director of Member and Partner Services for the Florida Association of ACOs. We are super excited for this opportunity to present to you our next installment of our webinar series, Physician Profits Prognosis, Making Risk Great Again. Before we get started, I'd like to share a few quick notes to help you make the most of your webinar experience. For audio, you're currently listening through your computer speakers, but you'd prefer to dial in by phone. Simply click the small arrow next to the microphone icon in the bottom left corner of your Zoom window and select Switch to Phone Audio. Follow the dial-in instructions that will be provided. We welcome questions and thoughts throughout our session. You can submit them at any time by clicking the Q&A icon on your Zoom toolbar. We'll collect them along the way and address them during the Q&A portion at the end of the presentation. Please feel free to use the chat box if you're having any technical difficulties. Our team is here to assist. Also, today's session is being recorded and we will be sharing it after. With that, I'm going to turn our presentation over to Terry. Terry, take it away.
Samantha, thanks so much. And Flacco members, we're delighted and indeed thankful for the opportunity of sharing an hour of your time to go over what we think is some very meaningful and powerful thoughts around risk. And so what we hope you come away with out of this session is just to be able to see what's happened yesterday, what's going on currently, what may be happening in the future. And so with that, Tommy, the next slide. So I'm probably dating myself, but if many of you can remember Aretha Franklin in her Think, Think, Think album, uh, she recited that. And so our goal this morning is to think with you what you might see as being good, better, and best. So the first thing is to think about CMS. And it's kind of, in her song, she goes, "What are you doing to me? What is CMS doing to us?" Well, I think we can all agree that it's costly, complex, confusing, and challenging. But risk from CMS doesn't necessarily have to be a four-letter word. Uh, so we hope to listen to you, to understand what your goals are, and have you tell us at the end, what do you need? Because we seek first to understand. So, as you can see, Albert Einstein, and I love his quotations, the fish swimming in the wrong direction. And a lot of times it takes courage to step out there on the cliff or in the water, as this case may be, and to entertain risk. And so the real key question is, what does the risk picture look like to you? So we want to go on a journey this morning, and in this journey, we want to educate, enlighten, and empower. So why do I say that? The main reason is that every firm, ACOs and so forth, uh, you want to make money or save money. And so we believe that by educating you, you can understand your choices before you. You can decide out of the options and choices that you might want to take full advantage of and enlightened in regards to that, and then empower you for greater success to propel you. So we're covering the current state of the ACO. We're doing some comparisons between the ACO CMS reinsurance and what it is in the private world. And then many of you have an adjunct firm, such as a sister company for MA capitation risk, especially in the southern half of Florida from Orlando to Tampa over uh, to Miami, kind of the counterpart to the Devil's Triangle, the Medicare risk triangle there in Florida. And then we want to give you some client stories to make it real. And then we'll wrap up by doing some takeaways and questions. But let me start with a story. I don't know how many of you watched recently, a couple of years ago, the movie Air. In that movie, Damon said, "You gotta take risk." So risk doesn't have to be the four-letter word. It can mean more profits to you. Next. So what's happened in growth in ACOs? So I don't have to tell you, and I don't have to show you the charts. Many of you remember the triple aim, and then kind of like this thing on the bottom, they had a growth chart between FFS and then shared savings, and then track one, track two, and then enhanced, and now reach. But Florida is kind of leader of the pack, okay? Nationally, there's over 700 ACOs. I think in Florida alone, it's somewhere between 115, maybe 130. Flacco's started in 2012. In fact, in that same year, we gave a Florida symposium in regards to ACOs and reinsurance and how the two intersect, but we were probably ahead of the curve. But we've known Nicole since that time, and many of you in Florida, from Dr. P. Singh and Dr. K and Rupesh Shah, and some of the larger plans operating in Florida with, and I might say, with a high degree of success. So we want to contribute to that success. And also, you see payers making major investments. They wouldn't be doing this unless there was a reason. Next.
Yeah, Mr. Terry, I was going to you talk a little bit
Yes.
about
Okay, it's yours.
this little piece, as you think managing and taking on risk. I mean, you all are providers providing care in your local communities, but because of the construct of our current Medicare program, all of you are taking on risk in some way, shape, or form. So let's talk about what that looks like, what some of the key issues are associated with that, and how we start to think about managing some of those differently than the way that you're managing them today. So first, stating the obvious, contract terms and negotiation of said terms are muddy at best, right? And so, what opportunities you have, what you're able to negotiate versus what you have to accept as you're dealing with your ACO REACH programs and your MA capitation programs. There's some ambiguity around there, right? And there's a lack of clarity around what all those terms and conditions often mean. Adding to that, the ability to access data in a timely manner and to really truly understand member attribution, what members you're responsible for, how they get folded into your capitated risk model. These are all points of confusion, that can lead to chaos, quite frankly, as you think about how you're managing your current programs. In addition to that, many of you are new to risk taking and or have a low tolerance for risk, right? Given the size of your membership or maybe your growth into some of these areas, there's a real apprehension around, your tolerance for how much risk you're willing to take on and what kind of exposure that creates for your enterprise, for your organization. And in addition to that, there's timing, right? As we think about when settlements occur, there's sort of that lag between an event or a claim is incurred and when it actually gets processed and when that settlement actually takes place, at the payer level, right? When they're actually finished and finalized doing that, right? That creates timing risk around payment, how you're operating and running your businesses, et cetera. And then last, but certainly not least, cost measurement is certainly a moving target as we think about trend estimates and risk adjustments and how all of those things apply, which actually sort of flow back into some of the earlier points around confusion around contract negotiations, member attribution, et cetera, right? So a couple of things on this slide as you think about is, what are some of the key aspects of running your business? What risk are you currently taking on? And how do you start to think about some of those things differently as you move forward and explore options and opportunities that exist to help you in some of these endeavors? So, as you think about managing and running an ACO, which all of you are doing today, there are really sort of four big buckets of risk that we could talk about that you all really have to think about, right, and manage. There's technical risk, right? Understanding the technical aspects of the contract, how those are structured, what your benchmarks look like, et cetera. There's performance risk, right? Your ability to actually deliver against those benchmarks, right? Against those capitated fee arrangements. And then there's certainly operational risk, like your ability to actually operate the business effectively, keep track of compliance, regulatory issues, et cetera. But what we're primarily going to focus on today is what I would view as insurance related risk, right? The risk associated with knowing which patients you have, how they're going to utilize healthcare services, the cost associated with those healthcare services, and trying to figure out mechanisms and methodologies by which we can manage and mitigate that risk as effectively and efficiently as possible. So today, we're going to talk a lot about insurance risk and how that risk can actually translate into opportunity as you really start to understand what that risk is and what options or opportunities you have to manage that risk that exist in the market today.
Tommy, let me add just one thing.
Please.
Uh, think of reinsurance as nothing more than you using the capital of the reinsurer to protect the capital of your ACO. So really, it's a money play. It's a smart money play. And as Tommy really laid out well, how you manage and plan that for maximum performance. Go ahead, Tommy.
Yep. And so two important concepts, and we're going to talk about both of these, but as you think about protecting against risk, there are two areas that are really important to understand and that we're going to dig deeper into, but just in terms of level setting. There is a sort of specific stop loss, right? Where we're really putting insurance or reinsurance in place to protect against those catastrophic claimants, right? Dialysis patients, cancer patients, right? Where a handful of those specific members could very easily destroy your budget, right? Your ability to achieve the targets that you're looking for, because in many of those cases, those individual claimants could be three, four, $500,000. I've obviously seen, this sort of growth in even members over $1 million in terms of claims. So there's this idea of individually protecting against those catastrophic situations. Now, the larger you are as an enterprise, right, the more ability you have to sort of manage some of those shock claims, right? And those are concepts that we'll talk about as we dig deeper in terms of how you think about what levels you set that protection at, right? How much risk you're willing to absorb, how much you can take on in terms of an individual claim, really disrupting, right, or sort of having a negative impact on your outcomes, right, on your performance at the end of the year. So that's sort of one pillar of that. The other is aggregate stop loss, and that's really more of a play against this sort of broader theme of utilization ramp up, right? So think about specific as covering member by member by member who may have catastrophic situations that we want to protect against. What aggregate stop loss is doing is protecting us against the downside risk of everyone utilizing at a much higher level than expected, which obviously has catastrophic implications to meeting your benchmarks, meeting your MA capitated cost thresholds, etc. Now, what I will say is for a typical group, for any one of you, you almost always will have specific stop loss claimants that we're protecting against every single year, right? It's just going to happen. How many and how large will vary, but they are going to exist. The notion of aggregate stop loss is not going to apply often, right? It's very rare that you're going to pierce that. But when you do, it could be incredibly catastrophic to the way that you run your business. And so, think of that as, protecting against, sort of the once in every 5 year, really, really catastrophic situation. And as such, that the cost of that coverage is typically more affordable. And then think about specific as being really there to protect against the month over month, year over year catastrophic claims that you all have within your membership today. And so I'm going to turn it back to Terry, and we're going to start to dig into these concepts and talk about what options and opportunities exist within each of these buckets as you think about managing your ACOs.
So I want to add one thing. Since you guys are in Florida, think of aggregate as catastrophic protection against hurricanes, and you have or could have more frequently claims on your auto or your home. And so that's kind of the difference and how you plan for those. And again, to Tommy's point, you're trying to create certainty from uncertainty in terms of cost predictability. And so now with the REACH program, and I'm just going to go over a couple of the highlights here. Uh, in 2025, they started allowing the REACH ACOs to have individualized deductibles per member, and they float depending upon the severity, the different methodology, the ratings. You can have anywhere from a 100,000 or 150 up to a 250,000 type deductible. When something like this varies and you don't know what deductible you have until the ball game's played, it's tough to have predictability. It's kind of like on your homeowners or your fire policy. I'm going to tell you the deductible after you tell me the loss. And so the larger the loss, the larger the deductible. And then they went and inserted these bands, and this is down at the bottom. And you can see how they float. And we're going to get into an example of this uh, uh, recently. But in the ACOs that we've talked to, and it's about in the middle of the page, and payouts must be budget neutral. In other words, a dollar of the claims against a dollar of the cost, if you will. And it's all ACOs in the REACH program in one bucket. And again, it's budget neutral, which means you may get money back, you may not. It depends on how that works because it's going against the mean. Now, on the next slide, we're going to get into a little bit of example of this with CMS, and I'm not going to go over this. You may have seen this in the past, but go under item number 4, and this is just taking a $500,000 claim, okay, line 3, against the residual expenditure line 4, okay? And then here's your wristbands from the previous page, 150,000, here's 100,000, and so the total payout is 220,000 per the 80% and the 100%. So now you had a $500,000 claim and you got only $220,000. Not a real good deal. Okay, next slide. So on this slide, we're just kind of showing you, well, what would happen if you had 150,000 deductible on each and every member, not have it bobble up and down like a cork in the sea or a boat in the sea. Next slide. And here's a real example. All right. And you can go through all these calculations. All right. But if you scroll down to the bottom out of this $500,000 claim, you see the CMS model pays 220,000. The direct private insurance pays 315,000. So you're getting $95,000 per pop when you do this. Quite a difference. Uh, that's almost like a little less than half. I didn't do that percentage, but 95 of 220, you can do it in your heads as well. So anyway, you see the bands, you see that. But if you were to have 10 claims, a half a million, and here's where it has budget impact, okay? That's $950,000 that could have been in your bank had you had private insurance versus the other. Or basically, I think we did this on, well, just the claims cost itself. Um, and I think we did this on 10,000 members. I'm not seeing that. But anyway, $7.90 PM. So there's that. And that was what
Well,
happened in that particular case. You have a comment, Tommy?
yeah, I do. We'll move along.
Pardon?
Meaningful cost reduction here. But in addition
You're
to
breaking up.
are real sort of implications around just clarity and confusion around how that model works, right? Where they're literally setting a predicted amount per
Mhm.
member and then, really tying everything back to that. So it's really sort of puts a lot of the control in CMS's hands. And you guys just sort of just have to play the game, right? And although that may be okay, as you all sort of continue to refine and grow and look for opportunities to expand your profits, right? Your revenues from these arrangements, it's really, really important to start to look at what is available in the private market to better support some of these particular items and some of these particular issues that give you more control, better access to data, and certainly, financial savings around how these programs are administered, managed, and support your business.
Okay.
All right.
Tommy, I
So I want
think
to
you
talk a
got it.
little bit about aggregate reinsurance, right? So Terry just talked about the specific component of that. So let's talk about aggregate reinsurance. And what's interesting is under the ACO REACH program, there's actually not aggregate reinsurance the way that we think about that, right? In other words, your risk is never really capped. There is always exposure, And that exposure really is driven by what type of ACO you are. Is it global or is it professional? Under a global program, you're taking on 100% of losses and gain, right up to that 25% of benchmark. And then there's a sort of a decreasing share that you absorb thereafter. But the same is even true under professional ACO, where you've maybe sort of dipped your toe in the water, you've sort of moved down that path, but you're not sort of under a fully capitated 100% risk model. And you can see here that although the savings and losses sort of decrease as you move through these different risk corridors, there is always loss that you are exposed to, regardless of performance. So there's really never any cap. There's a diminishing return there, but it's sort of this uncapped exposure that you have. Which could very much apply in one of those years where you sort of happen to have a single bad year, right? Which all of us have. You all have almost certainly experienced at some point, if you've been running your ACO for long enough, where in many years you're seeing that upside, right? You're seeing that 50%, 35%, savings come back to you. But call it one in every five, one in every 3 to 5 years, you have sort of a really poor performing year. And in those situations, you've sort of got this unprotected exposure of downside risk that just exists under the ACO REACH program. So how do we think about that in the private market? There are a couple of different ways that you could structure that, but just to sort of keep this very, very simple and very clean, your retention sort of sits at a level where you're taking on risk up to some threshold above that benchmark, right? So you all have a benchmark target you're trying to hit. That private insurance would typically set that benchmark at 3%, 5%. These are all variables we can explore, right? You have flexibility in that model in the private market. But we look at that benchmark at being 103%, and then anything above that, that reinsurer is now protecting you and taking on all of the risk for losses above that 103% of that benchmark up to some sort of stated amount, right? Which is very, very unlikely that you're going to pierce, in this example, $10 million in reinsurance coverage. But if you did, you would start taking on risk above that limit. But what it really does, it allows you to really cap your exposure in any given year and really protect from sort of that catastrophic scenario where you have high utilization, you have some very complex, expensive claims, and you are now in a position where you're performing, at or below your benchmark. And have downside exposure that we're trying to protect against in this model. So it's a really clean way to really explore and think about how to manage the risk that you're taking on in your ACOs and under your Medicare Advantage programs.
So what you see here is the key differentiators in cost between the CMS reinsurance versus private. And we've talked a lot about these. You can see how in the aggregate uh, coinsurance disappears, but then there's the claims reimbursement. For the first time, CMS is trying to listen to the ACOs and in some cases are willing to advance 50% of the projected shared savings. In the past, the settlement has normally been 9 months after year end. Okay. So you perform, you go to the on deck circle, and you sit and wait. Where in the private sector, when you have a claim, you submit it. It's normally paid within 2 to 4 weeks of that, better cash flow. And then the cost certainly is determined by regional and national experience, whereas in the private world, you determine the cost. So you are what your lab results say you are. So if you're a better risk, it's going to be reflected in a lower price point. Uh, Hence, again, the CMS model says budget neutral or break even. Again, 50% of the ACOs we've talked to didn't even know that was set up that way. It was kind of a shocker. So it's kind of like you get in the ball game and then all of a sudden you learn the rules some of them not too favorable. And with the private insurance, it generally is cost competitive with a financial focus for cost efficiency improvement. Then on the next slide, we tried to break this out a little bit further, and this is more detailed. That's the reason we did the key differentiators slide. And so I won't go into all of this except if you look under customization, it's a cookie cutter approach when you use CMS. When you go into the private world, we believe one size never fits all. So we have kind of a Burger King approach. Have it your way, and you can determine what deductible you want, 150, 200, 250, whatever, up to say maybe $1 million. Administration, while it's different, it's not punitive. Okay. And hence, many of you, if you've got a MA program and you're buying your own reinsurance, you're already familiar with how to file claims with the reinsurer, how to monitor, how to turn them in, and how to get paid to your bank account. So we really don't see that much of a problem when a program, especially for those mature ACOs. And then the underwriting, again, we've talked about this based on claims history and risk review under the private uh, flexibility, very much negotiable. So you can see a few things, a few more things there. And then the next slide, you go, all right, with all of this, and we've harped on this. Did you have something, Tommy?
Well, it's just before we transition, because I think you made a couple of really good points there that I just wanted to sort of emphasize, which is, under your current, what most of you are doing under current CMS reinsurance, it's very standardized. You have very limited control, and you have very limited access to data. On the right-hand side, it is fully customizable. You have full control over how you structure the program, and you have access to data, right? And so just wanted to sort of highlight at the bottom line on top, that's really sort of what these opportunities provide you all with as providers. Now, I fully understand not all of you are comfortable moving down that path or ready for that. But for many of you, it's a really excellent opportunity to really take control of some of the components of your program. Sorry, Terry.
No, excellent comments. So on this slide, so which option is best? Well, and Tommy alluded to this, if you're probably new, okay, probably CMS may be the best option. Yes, it's costly. Yes, it may be confusing, but there's less you have to do on your part, okay? But if you're in the risk game, if you're playing the risk game, then why wouldn't you, quote, be willing to do what it takes to take more of the risk? When you take more of the risk, vis-a-vis, you get more of the rewards. So in the private side, this is really for the mature. You can see desire for less cost, data rich, which Tommy alluded to, strong analytics, all the data that goes into design and structure. Because if you design it right and you structure the reinsurance properly, then you're going to get the right results. Then let's talk a little bit about financial uh, solutions. Okay. And so we wanted to lay out just in a big picture deal We all know that there's a financial repayment penalty. You want to see more of this. And so we've structured something unique in the marketplace so that you can have a surety bond, but virtually little or no collateral. All right. Reinsurer financing. We can use the balance sheet of the reinsurer to advance monies to you on day one of your risk. So everybody's getting ready to file now for 1/1/26. But on 1/1/26, whatever your shared savings is projected to be, we can get you 50 to 80% cash through a loan to be paid back at the end of the performance year and end of the 9 months calculation from CMS when they finalize it. Then Tommy's going to talk about different, what I call money management tools, how you risk share with the reinsurer for additional savings. And certainly there's a captive strategy that we're going to talk about in our next webinar to show you some interesting financial concepts there. Uh, Next slide. Okay, so this is kind of some of the same thing that I alluded to before. Go down in the red, you can see that you're satisfying the bond collateralization with little or no collateral. Okay, and so how does that happen? Well, the way it happens is that on the next slide, yeah. So on this slide, you see that the reinsurer puts up a reinsurance policy and they can pledge that and the returns over to the surety company. Now, on the surety company's balance sheet, instead of showing a liability, they can put in there that it's back to break even, hence no collateral. So they give the financial guarantee to the ACO. The surety company is on the CMS's treasury list, and you pay premiums over to the reinsurer. And of course, the recoveries come back to you as you file them, or if you take an aggregate based upon year end. And then I'm going to let Tommy talk about the next slide.
And this is really just to highlight some of the options and opportunities that exist. We'll cover a few of these in detail this morning, but more importantly, the idea here is just highlight some of the options and some of the flexibility that you have in the private market to really think about how you manage the risk that Terry and I have been describing thus far. So obviously, flat deductible is the simplest. $150,000 for any member who pierces that. You've got reinsurance protection, you get reimbursed. Very, very simple. As we start to talk about some of these other concepts, this is where working with somebody like Terry and myself is very, very valuable in terms of understanding what other opportunities are out there to manage risk and also mitigate upfront premium costs associated with some of these financial mechanisms. So think about concepts of an aggregating specific deductible, where not only do you have a flat deductible, but you have sort of a pooled amount of money that sits over the top of that, where you all are taking on some additional risk, but for the sake of reducing your premium cost. So it's a really great way to think about leveraging fixed costs associated with premium versus risk. And that's really the game that we're playing. There are ideas of things around combined aggregate program, which we're going to talk about in more detail, where it actually gives you the opportunity to take multiple different programs with different membership and pool those together in one larger program that obviously is going to be more cost effective because we're managing it across a larger set of members and taking on additional risk. So it allows us to really bring this concept together of, look, for those of you that have ACOs and MA programs, et cetera, maybe even are bleeding into commercial space. It gives you the opportunity to bring multiple sets of risk, sets of membership with different HMOs, different payers, et cetera, into a combined program that may in fact be most efficient economically for you all. So let's talk about one or two of these again without going too far off the rails here. This idea of sort of pooling, sort of aggregate reinsurance, right? So this is the idea, and again, I could absolutely see something like this existing for some of you who are collaborating with other ACOs, or maybe where there's a parent company where you have multiple ACOs who sit underneath that. Or even in partnership with Flacco's, you all have sort of this loose affiliation where you can look at programs by which you're pooling risk across multiple ACOs for the purposes of getting better economics, right? Law of large numbers. The bigger you are, the better deal you're able to procure, the more predictable the risk is. And then it's really a matter of procuring that across multiple entities, but then developing the right mechanisms internally to actually share in that risk, to share in those profits across those ACOs. So a lot of really cool things that you can explore in this type of environment that give you leverage and give you access to better pricing and better risk spread. In addition to that, the other one that I talked about that I think is really, really fascinating is this idea of a CAP program, right? Combining aggregate reinsurance, essentially having a single policy that can sit over your ACO as well as any MA risk that you have. And even though those are very different programs, you're still managing a lot of the same types of risk conceptually. So having a reinsurer who sits over the top of both that gives you better pricing and better protection and pooling of that risk across all of those contracts could be very, very valuable and from a cost perspective and a really effective way to manage risk across a broader set of members in a very, very efficient way. Terry, I'm going to turn it back to you, sir.
Yep. So now we're going to get into MA and talk briefly about this next. And so we're going to pull back the curtain, if you will, with Florida HMO rates. And here's why I say that's a flawed model. They tend to rate high, they put their stuff on a regional deal versus your experience. Next. So let me explain this. Okay. The old model said that you buy the reinsurance from the HMO. The new model says, wait, au contraire, you can quote, uh, have advanced risk and cost savings by going direct and bypassing the HMO. Now, in some examples, there could be a tranche layer in there for you. There doesn't necessarily have to be. You can take it from the ground up. And so now that's old model, new model. Let's look at how they rate. So on this slide, here's a depiction of, quote, everybody being thrown into the soup, if you will, by Humana, by other HMOs there. And so typically they use regional rates for South Florida, different rates for Central Florida, different rate for Tampa, and then certainly a different rate if there's any risk takers, which there's very few of, North and West Florida. But they use your experience. They use peer rates. They may use manual. They blend this together. Not so with the HMO. So if you got 10 HMOs and they're paying these rates over there, you can quickly see that on a $40,000 deductible, the ones that are below the tipping point is supporting the bad brethren, if you will. So it's like the good ones are being handicapped, like the horse in the horse race, and carrying more pounds than they should. Okay. Not a good deal. Okay. For those that are outperforming. Next.
Yeah, and again, I think conceptually, Terry,
Mm-hmm.
the exact same dynamic applies here as what we talked about with the ACO REACH program, which is the HMOs make it very easy for you to buy reinsurance from them. But this is sort of what you get, which is this is our pooled rate, based on the amount of lives you have. This is the deductible that you're required to take, and this is the price you get, period. It's not based on your own experience. You have literally no flexibility in terms of how you structure that. So it really handicaps your opportunity, one, to understand your data, two, to get pricing based on your data, and three, to have any control over where that risk profile is set and what you're paying for taking on that risk.
Yep. Now, Tommy, were you talking about this or me?
Happy to. They're a great example of an actual client that Thierry and I have supported as they transitioned from their traditional HMO model into a private insurance model where we developed what we would call a gap policy. This is a provider that had 2,000 MA members at a 40,000 deductible, and you can see what they were paying on average across their HMOs for that coverage, $208 per member per month. What we did is we actually went to the private market to really help them evaluate different options that we could pursue that may be more financially advantageous. So if you think about what's on the right under that gap approach, they still have literally the exact same protection in place now under that GAP program where we've gone to the private market and secured reinsurance for any claim between 40,000 and 150, and then asked the HMOs to continue to reinsure, but only reinsure at 150,000 and above. So it actually allows us to look at their pooled rates, determine where that break point is, and where in this particular case that client could win financially having the exact same deductibles, so the exact same protection in place, but saving over $1.3 million annually, $55 per member per month, by simply surveying the private market and securing reinsurance outside of their HMOs. So, really, really great example of being creative and having a lot of flexibility with how the program is structured to design to maximize profit.
Yep. So what we did, this is just a simple example of splitting the baby and then rehooking it up, kind of like a train to work in tandem. And to Tommy's point, not a penny worse, not a penny better in terms of protection. Same identical protection. And you see the savings, $55, a million 320 that they could take to the bank, drop to their bottom line. And then the next,
Yeah. And so we'll talk a little bit about some examples, right? So in addition to the one that we just described, what are some of the other situations and scenarios that we've actually encountered that tie back to some of the opportunities and some of the examples that we described in our presentation today. So this is an example of a much larger MA provider, and we'll talk about an ACO opportunity here in a minute, who had escalating loss ratios and, with 25,000 members, they were being significantly overcharged for reinsurance. Now, because they are much larger, their reinsurance level was set at a much higher limit than where it was with the previous provider that we talked about, where their limit was at 40,000. So in this case, we're dealing with a much higher limit, but they were still significantly overpaying for that coverage because of that pooling concept that Terry described a little bit earlier based on that illustration that we looked at. This is a very high performing MA provider who was overpaying because they were being pooled with a bunch of low performing MA providers. They were paying literally 41% above what was available in the private market. So, what did we do here? We transitioned this group to a private reinsurer and helped them secure over $3 million in savings versus the HMO reinsurance that they had historically purchased from the plans that have the members that they're insuring, right? That they're covering.
Yep. And then the next slide talks about capital financing, and you heard me allude to this before, and we're about to wrap up here. So we were able to use their past ACO performance, got them financing of $5 million, and then they could use this for their operations, working capital, internal acquisitions, ever how they wanted to do it. So rather than waiting until year end to get their money, they got it on day one and they got $41.66 PM for the rest of the year, so to speak. But $5 million up front. I just showed that to illustrate. So the takeaways here is we have tried to listen to you. And so we want to know, what do you need? What do you really need to be more successful? So we believe it's a new day for new dollars, for new profits to doctors, and it's your timing, it's your turn. If you remember what I alluded to at the beginning, where I used the movie Air, at the end of that movie, Matt Damon asked Michael Jordan, uh, is it in you? Are you into this to make this shoe Nike better? He signed up, Nike signed up in 1984, 85. Nike's percentage of NBA players wearing their shoes was 17%. Today, that number in the NBA is 67%. They roll the dice on one player. They had a budget of 250,000, did it. So my whole point to this is that you can succeed and you can create gains. You can use smart money management. There's there's a different model, different mousetrap, and you can control ultimately what your risk looks like because it's your dollars and your hand is on the buzzer to do with it what you want, or should I say, you have the paintbrush to paint the picture, financial picture that you want. And so with that, we turn it back over to well, there's our captive. I'll just say that. Show that next slide, Tommy, real quick. All I'm going to say here, there's different risk and you can see, but most people in a captive don't realize you can put star ratings, medical capitation, Medicare risk adjustment, loss of a physician. And then you got fund uses from dividends to loans or collateral or whatever. And we'll get into that in the next webinar. So Samantha, it's all yours.
All right. Well, thank you for that, Terry and Tommy. I got a few quick questions here for you. One of the first ones I do have is, can I have one aggregate reassurance policy for my ACO and MA risk? And if so, or how long of a lead time needed to get that in place?
Tommy, you want to answer that or me?
Yeah, I'll take the first part and then I'll let you talk about the timing piece. How about that? So we'll just sort of
Okay.
split this apart. So, Samantha, to answer your first question, yes, there are all sorts of unique things that we can do in the private market. And combining those two programs and multiple programs into one reinsurance policy, very, very viable and also very, very valuable, where it makes sense for the right group who sort of understands how we're structuring that. So the short answer is yes, you can absolutely do that. And then Terry, maybe if you want to sort of take the timing question around when those decisions need to be made and how that process would work.
Yep. So anyway, we normally like to think the more complex it gets, and this is really a banking transaction, you're using the balance sheet of the reinsurer. I would say you really want to start at least 3 months in advance, collect the data, go to market, get the results, show them, and then Tommy shows it in a net cost analysis. So you're able to see actuarially what is the best option for you on a pure actuarial economic proposition. But we like to say 3 months. If you just wanted MA coverage, if you just wanted ACO, we could probably do that in 2 months. Okay. But for combining and looking both risk, and we may do the aggregate, we like to say 3 months.
Okay. When does the MA capitated risk claims get paid?
Normally, they get paid within 2 weeks to 30 days upon receipt of a complete claim. And so you do all this electronically. They get your UBs, they get your HICFAs, they got to have the rev codes. And so they get this uh, and to their portal. It's all HIPAA compliant, and then they turn that around and get it right over to you either through a check or some type of ACH/wire transaction.
Okay. The last question that I have for you both today is, what are other ACOs doing to protect themselves versus the new CMS reassurance program?
Well, what most of them are doing today, they're strongly looking at the aggregate, okay, for themselves for the ACO. And then we've got a lot of interest in this combined program because generally we kind of created this uh, combined aggregate into one policy. Now you have to be in one state to do it, okay, because of filings, okay. So your ACO and the MA would need to be in the same state. Or we may be able to do some type of front company if you had a captive, okay, and do one policy for multiple states.
I'll
So,
just add, I'll just add, Terry. I mean, I think as a general theme, the size of your organization does in fact matter in terms of how far you've advanced and progressed down this pathway. That said, so many large ACOs or MA programs have already moved down the path of, creating or supporting, private insurance or private reinsurance structures. I do think there's a tremendous opportunity economically for smaller ACOs and MA programs to really benefit from those same concepts. It's really just a matter of helping you all understand the risk profile of your business, what the right limits are, and evaluating opportunities and options that exist in the market. So just because you're smaller doesn't hinder you from exploring these situations or these scenarios. Although many of you feel that way, right? We're strapped for cash. Cash flow can be tight. Having it run through CMS or through the HMO is just easy. The problem with easy is you're paying for that, right? You're actually sort of foregoing a lot of economic value to the enterprise that you could retain or keep. And so I think that would be the way to answer that broadly, Samantha, is there's a lot that are still sitting within CMS and or the HMO. Hence the reason for this discussion today is to maybe bring these options and opportunities to the forefront to make sure that you all know you do have options, you do have choices, you can do this too. As we think about sort of wrapping this up, and I know we're at time, so maybe that's a great way to end, Samantha.
Perfect. Thanks for that, Tommy, and thanks for that, Terry. And thank you for sharing your insights and your expertise with us today. And thank you to everyone who joined us for this informative session. Just as a quick follow-up, we'll be sending an email that includes our presenters' contact information should you have any additional questions, along with a link to the webinar recording. So please feel free to share that recording with colleagues or peers or people who may find it valuable. Again, thank you. We appreciate you bringing this great information to our members, and we hope you have a wonderful day.
Thanks so
Thanks,
much.
Samantha.
Take care.